The risk of a serious recession and another stock market crash just went way up. This is not a drill, and this isn't clickbait. This is about you protecting your money from what's happening right now. In this episode, I'm going to show you the one piece of data that everyone is missing and exactly how I think it will cause the next market crash. Your time is valuable, so let's get right into it. A couple days ago, the Federal Reserve raised interest rates by another 75 basis points. That's the third major increase in a row. And right now, interest rates are the highest they've been since the great financial crisis of 2008. The Federal Reserve's chairman, Jerome Powell, also said that they plan to keep raising interest rates even if doing that ends up causing a recession. They have to do this in order to fight inflation.
Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions.
That's all they've been talking about all year, so I think everybody really gets that by now. But it's important to understand why they're raising interest rates so high and so fast, even if it means risking our entire economy. To see why, let's talk about what would happen if the Fed didn't fight inflation. The costs of goods and services would keep going up, and workers would start asking for higher wages to cover their own increasing expenses. But paying workers more sounds like a good thing, right? Everyone could use more money to keep up with inflation, so what's the problem? Well, the problem is that increased labor costs would force businesses to charge more for their own goods and services, which means more inflation, which means workers wanting even more wage increases down the road, which means even higher prices, and so on. This is a vicious, never-ending cycle. So when the Fed says that they want to avoid inflation becoming entrenched into the economy, they're talking about trying to stop this vicious cycle from kicking off in the first place. Here's the thing, there's a lot of different factors responsible for price inflation today. Some are man-made, like the broken supply chain, production shortages, and the war between Russia and Ukraine. And some are natural, like winter bringing colder days and longer nights, which increases the demand for energy to heat homes and keep the lights on longer. But the Fed can't fix broken supply chains. They can't fix the war between Russia and Ukraine, and they can't make winter warmer or short days any longer. The Fed can only affect demand, and they do that by raising interest rates, which makes borrowing money more expensive. That means less spending by individuals and companies, which should ultimately mean lower prices down the road. And since some of that money goes towards paying workers, one consequence of higher interest rates is also higher unemployment, as companies start cutting jobs to cut their costs. Alright, here's the thing. The Fed has been raising interest rates all year, so everyone expects inflation to start coming down. For example, just this past month, analysts and economists expected inflation to come down to 8.1%, which is just a little bit lower than the 8.2% we saw the month before. But instead of shrinking like everyone expected, the inflation report actually came in at 8.3% year over year, which is higher than the month before. So even though the Fed has been raising interest rates at a record pace, inflation is still running hot. So what's the Fed going to do about it? Well, according to their latest projections, they're going to keep raising interest rates even higher than they previously predicted, which will put even more downward pressure on the economy and the market over the next 12 to 18 months. But before we look at just how aggressive the Fed's new schedule for rate increases is, let's talk about something even hotter than inflation. Today's sponsor, Cometeer, and their hot new take on coffee. Let's be honest, I'm the kind of guy who thinks about my next cup of coffee while I'm still drinking this one. I've tried everything from grinding my own beans to fancy espresso machines, which taste great but come with a lot of work and cleanup. That's where Cometeer comes in. They work with specialty roasters to grind and brew barista quality coffee. Then they flash freeze it to lock in the flavors and the freshness. All you have to do is add 8 ounces of hot water and enjoy. I love the taste and the convenience, especially during busy mornings. It really does taste like it came from a local coffee shop, but without all the hassle.
That's good.
I also love that Cometeer's capsules and packaging are 100% recyclable. For a limited time, you can get 25% off your first 2 orders when you use my code TICKER25 at Cometeer.com. So if you've been wanting to try Cometeer, now is the time. But coffee isn't the only thing that Fed wants to see go down in price. In fact, the Fed tends to look at core inflation, which excludes food and energy altogether. Core inflation tends to be a good number to go by because everyone needs food and energy regardless of how much it costs. Not to mention that food and energy prices can actually be pretty volatile. And guess what? The latest report showed that core inflation still increased by 0.5% month over month. That's why the Fed just updated their dot plot, which shows their newest projections for how they'll adjust interest rates over the next few years. The special thing about this latest dot plot is it's the first one to include projections all the way through 2025. Let's take a look at the numbers. Here's the previous dot plot from their June meeting. Each dot on this plot represents one FOMC member's prediction for where interest rates will be that year. So, for the June meeting, the committee expected the federal funds rate to be 3.25% to 3.5% in 2022, just under 4% in 2023, back to 3.25% in 2024, and settle around 2.5% in the long run. Now let's look at how that's changed based on the latest inflation data. Now they expect rates to settle at around 4.5% in 2022. That's at least a full percent higher than their estimates from just 2 months ago. Their 2023 prediction is now 4.75%, which is at least 3/4 of a point higher than their previous estimate. Their prediction for 2024 is at least half a point higher, and the same goes for 2025. They still expect the terminal interest rate to settle at around 2.5%, but that number just got pushed out at least another year. So now we should expect interest rates to be around 75 basis points higher over the next 2 to 3 years. What does that actually mean for stocks? Here's a great explanation by billionaire investor Chamath Palihapitiya from episode 73 of the All In Pod.
When rates are zero, typically people are willing to pay 8 times revenue for a company. Okay, so if you're generating $100 million
revenue.
Top line revenue, if you're generating $100 million of revenue in your reasonably high margin, reasonably high growth software business, that's worth $800 million in the public markets. For every 100 basis point increase in rates, you decrease the valuation between 15 and 20%. So if you think rates are at 2.75%, the price is somewhere between 30 to 40% cheaper than what it was when rates were at zero. So if you go back and you look at every TechCrunch article and every Bloomberg article and every information article, and you look at all those headline valuations when rates were at zero, we all just said rates are going to be somewhere between 2.5 to 3% at the end of this year. At a minimum, you have to haircut those things by 30 to 40%. Steady state, meaning the company is continuing to execute on all cylinders. If they have a downtick in their performance, then it increases that discount. If rates go higher, it increases the discount. But the basic way to think about this is for every 100 basis point increase in rates, you got to downtick that valuation by 15 to 20%.
So there are 2 things from that clip that are super important for investors to understand. Let me just be super clear here. The first thing is that interest rates are projected to be 75 basis points higher on average for the next 2 to 3 years. That means that the valuation for every great high-margin tech company should fall by at least another 15% from here. So if you're seeing red all over your portfolio as things move down 1 to 2% each day, realize that this could be going on for a while as big institutions reevaluate these companies and apply a heavier discount rate to their future earnings. And that brings me to Chamath's second point, which is this 15% down assumes that the company is running at a steady state, meaning their earnings are as good or better than before. Or if they're not yet profitable, their top line revenues are growing by at least the same rate as before. But we already know that that's not happening for most tech companies right now, since many of them had a lot of growth that got pulled forward because of the pandemic. Now, a year or 2 later, their growth rates have slowed significantly because the economy opened back up. People have more options on how to spend their money, and they have less money to spend thanks to inflation and a lack of stimulus checks and so on. So, because of higher interest rates and lower earnings, we should expect valuations across the board to fall even more than 15% from here. Now let me show you why I think interest rates will go even higher than the Fed's most recent dot plot shows. This is the one piece of data that I think is the nail in the coffin, and why I think a recession is much more likely than most people realize. Let me set the stage by looking at a breakdown of the latest inflation data really quickly. Here's the breakdown of the changes in the CPI from July to August. So these are month-over-month changes, not year-over-year. A big reason that headline inflation wasn't even higher than 8.3% was because fuel oil, airline fares, and gasoline were way down in price. Just to be clear, airplane ticket prices are affected by the price of jet fuel. About 10% of the price of a normal economy airplane ticket is because of the fuel. The reason that fuel oil, jet fuel, and gasoline prices are down so much are at least in part because the US government has been subsidizing oil supplies by selling off a large portion of our strategic petroleum reserve. Over the past year, the government has sold over 100 million barrels of oil from the stash, deploying almost 1 million barrels per day since the middle of May. The total reserve was less than 700 million barrels at the start of 2020. Today, our reserves have already been cut in half, and they're the lowest that they've been since 1983. The US can't deploy the entire reserve either. They need to leave a good amount in there to cover legitimate emergencies like hurricanes. So we're getting close to the limit of the number of barrels the US can actually deploy to level out our fuel prices. Releases from the reserve are currently set to stop at the end of October. When that happens, Goldman Sachs estimates that oil and gas prices are going to go back up to around $5 per gallon. Remember the numbers from the CPI I just showed you earlier? These huge decreases in fuel costs were the only things keeping headline inflation down. When they reverse course, headline inflation will go up. The Federal Reserve will see that data and they will raise their projections for interest rates even higher.
Reducing inflation is likely to require a sustained period of below-trend growth.
That means a deeper bottom for the stock market, even lower spending in the economy, and ultimately even higher unemployment than we currently expect. I'm not going to pretend that I know where interest rates will actually end up over the next 12 to 18 months, but just think about how much higher they're projected to be now than they were just 2 months ago. There will be no soft landing. The Fed will raise interest rates to restrictive levels, and as a result, the recession is coming. The market bottom is still ahead of us. The thing to watch for the rest of the year is fuel costs. The thing to do in the meantime is to protect yourself by building cash and paying attention to earnings. Earnings that should come in lower than expected, which adds even more downside risk when you add them together with higher and higher interest rates. Don't say I didn't warn you. And if you want to see more of my market research, check out this episode next. And if you feel I've earned it, hit those like and subscribe buttons. That lets me know to make more content like this, and it tells the YouTube algorithm to show it to more investors who might find it helpful. Either way, thanks for watching, and until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.